Alright friends, welcome back. This is a quick strategy step explanation. When the situation like that hits, when for example you have an active LP position, you've been yield farming for, I don't know, a few weeks, maybe a month or so, and then the market starts to go down every single day. So now you have to constantly rebalance because you're out of range, and you're rebalancing using one of the strategies to maintain the 100% asset deposit ratio, right? So it always happens because the mindset and the human psychology works this way at first when you are not used to that thing and you don't have the self-knowledge. So you are in range, you are yield farming, everything is beautiful, right? You're getting the fees. Then the market starts to go down and, for example, exits your range from the downside. So you are now sitting fully in, let's say, Sol, because the pool was Sol USDC. Now you are sitting fully in Solanas. And the first thing that human brains is doing always is like, oh, okay, so I'm now out of range. I hope it's gonna come back, right? So you give it some time, as you should, a few hours, 10 hours, right? And it's not coming back. It's actually going down even more. So you are now thinking, okay, so the market is going down even more. Let me quickly rebalance. So I stay in range and get the fees anyway because you are in Solanas anyway. So you rebalance the pool, not giving a range downside, only range to the upside. Now you are yield farming again, and then it goes out of range again and again and again. So for example, the very similar situation is happening right now with Solana. This is a daily chart on Solana. As you can see, for example, if you started to yield farm within this area right here, right? This zone right here, and you are like entered somewhere here with Solanas or with USDC or 50-50 depending on your goals of the liquidity provision, it started to go down. So maybe after this candle here, boom, you are now out of range, assuming, right? So you say, okay, let's give it some time. Next day, boom, even more downside. So you rebalance the pool, no range to the downside, only upside. So maybe here you stayed in range for most of the day, you've been farming, beautiful, okay. Then you are out of range by this or very close, then you back, then you out, then boom, another candle down, you could be out of range, so you rebalance again, then it's a small downside day but still down, then even more. So to avoid these things when the market is going down but the macro view is still bullish, this is the core idea. This is what you have to understand. This is the best. You should focus on this only if you think that you are macro bullish and these short-term downside swings are temporarily, so to speak, and you expect a fast recovery. Fast, I don't mean that it's gonna be through one candle, but I mean that it's not gonna take years to recover, okay? So, now there is a possible solution for you to actually maximize your upside potential and still stay in liquidity pool. Because as you know, if you rebalance constantly and then the price decides to come back to the upside quickly, you will be converted on every step of the way. As the price is going up, you will be converted towards USDC, right? On Sol USDC pool as an example. So if the recovery is quick, fast, aggressive, you can be out in USDC fully, fairly quickly, and you will miss on all of the potential upside that I like to call the opportunity cost of being in liquidity pool, because you are now fully converted to USDC, but Solana is still going up. And this is the idea, because Solana actually pulled back quite a lot from the previous high. It is now down pretty much 50%. So this is a standard for all coins on their pullback after going towards the all-time highs, right? So the recovery can happen quick, and it can be strong and extensive. So this the recovery chart for this might not look like 1 or 2 bullish days. It can look, fairly aggressive. From here you can go, fairly aggressive, so to speak, which means that if you stay in liquidity pool with Sol USDC and your range is, let's take an example, something maybe like that, which is not a bad range. It's about 30%, but these 30% can be achieved fairly quickly after 50% pullback. I hope you get what I mean. So in this case, you will be out of Solana and converted fully in USDC. And if Solana goes for the new highs, for example, which is still in play, in my opinion, this is just fairly getting started, so to speak, in my opinion, then you will be missing out on all of those profits. Yes, you can immediately exit the LP, swap back to Solanas and hold them, ride the wave, or put another range on top of this one. So the market went up, you are out of range, so you exit the pool and you immediately swap back to Solanas and re-enter once again with the higher side. That's possible. Or you can have a different strategy, which is exit the liquidity pool, right? When you are fully in Solanas, so when you are out of range, instead of constantly catching the bottom and rebalancing, you can exit the pool, deploy the asset, in this case, in this example, Solanas, to the lending protocol like Camino, Drift, you name it. And then you can borrow USDC and redeploy to the same pool, right? So you had, let's say, $5,000 worth of liquidity pool. You are now fully in Solana's worth, let's say, 3K. Yeah, there was a drop in the market. So you now have 3K worth of Solanas, right? And you had 5K total upon the time of deposit. So what you can do is exit the pool, because you will get back only Solanas, 3K worth of Solanas. You can now send those 3K worth of Solanas to the lending protocol, so you keep all the upside. You maintain full upside if it goes up. If Solana is going up, if it's recovering quickly, you are fully exposed, net long on Solanas. And then you borrow stablecoins USDC against your Solanas and then redeploy back to the same pool. Maybe even with the same range, doesn't matter, right? So what happens in this case? First of all, you maintain full upside potential, right? Meaning that you will not lose on the opportunity cost if you stay in the liquidity pool. So if Sol, for example, recovers fast, you keep the whole upside, right? The downside of this is that you will re-enter the pool with borrowed capital with smaller position size, because you cannot borrow maximum LTV. Meaning that if you deploy 3K worth of Solanas to the lending protocol, you will borrow maximum up to probably 2K, maybe even 1.8K, just to stay safe on the borrowing limits. You cannot borrow the maximum, right? I told you this many times before. So you can borrow maximum. So you will re-enter not with the 3K into the pool, but with 1.8, for example, which is smaller, almost double almost 2 times smaller position size, but you're still in the pool, still farming less, of course, because the position size is smaller, but you maintain the full upside of Solana. So if Sol is going up aggressively, you are not kind of stuck within the liquidity pool on a bullish momentum, and you keep the whole upside, which will eventually, at the end of the day, will be more than yield farming using 3K, because you will be out of position fairly quickly if it goes aggressively to the upside. So to manage these things, the idea that you entered with a smaller position size, well, basically you can either choose smaller ranges and active them more actively and manage them more actively, because, well, it's borrowed USDC. You can now change, redeploy, do whatever you want, because your own Solanas are now chilling, waiting for the price appreciation. Your borrowed USDC can now be moved around, small ranges, more aggressive approach to yield farm as much as possible, right? Or basically, you can accept the fact that, well, smaller position size is a price for being a full Sol long exposure, exposed to full Solana longs, by lending them out and borrowing less and redeploying less, but, well, you keep the whole upside of Solanas. So this is one of the ways to manage the situation when the market is going down short term, but you expect recovery as well, and you are macro bullish, so you don't think it's going to be a bear market for, I don't know, a year or two, right? So then it makes sense, because the more the asset goes down, the more likely the possibility is that, well, at some point it's gonna hit the ground and the market's gonna reverse. And if you stay in LP, rebalanced 20 times already because the price was going down and down and down, at certain point it's just not worth it anymore. It's better to simply keep the asset, leave it in a lending protocol to keep the whole upside of the recovery, because that recovery can happen fast and quick, and you can make more gains or recover from any impermanent loss quicker by lending fully in volatile asset, borrow some stables, redeploy to the pool to still be within the cash flow, still build the cash flow, right? Earn the income, so to speak. But meanwhile, your Solanas are now in position to gain the most possible profits, because you hold fully in Solanas at the very lows of the chart or the market, so to speak. So it does make sense. So you have to test these things out if you wish, and this is one of the strategies. I mean, for the moment, I personally am not doing that, because I have my separate treasury portfolios where only long-term assets are sitting and I am not touching them. If needed, I am borrowing against them in stable coins, but I'm not basically touching them. I'm only increasing the size of them, sometimes from the yields, sometimes compounding. Whatever happens, I just constantly stack more assets, but I have them. And some people that are coming to DeFi, they don't have the treasury first. They have some assets or stable coins or whatever, and they want to build cash flow without having the reserves or the treasury assets, etc. So then it's a possible solution to that, where you essentially farm, but when you see that the market is not going well, if the market is going against you, is going down and down and down, but the macro view remains bullish, so this is a short-term downside pullback, then it makes sense. When you see that the market is now 20, 25, 30, 40% down from the recent highs, then it makes sense to simply exit the pool, lend the asset, borrow some stables, redeploy, but keep the whole upside. That's the core idea, okay? It's not always you have to do that, but it's a possible solution to actually maximize the potential upside gains without sacrificing your liquidity position. So you stay in LP using borrowed capital, and you lend fully in volatile asset to keep the whole upside as well. So this is a pretty good workaround, so to speak, to stay in pools and experience full net long exposure to the volatile asset. So thank you, and of course, if you have any questions, make sure to message me and I will answer them.